So, why aren't mortgage rates plummeting with the recent Fed announcement? What exactly is the Fed? What's the Fed funds rate? And then what does it all mean for mortgages? Hi, I'm Travis Peace with Novum Home Loans. Let's break this down into simple terms. So first off, what exactly is the Fed? Think of the Fed, or the Federal Reserve, as kind of like the Bank of the United States. Now, we as consumers can't interact with the Fed, only banks can. So the Fed does several things, but one of the things that the Fed does, which is probably the most important, is it lends money to banks for short periods of time. So why do they lend money to banks? Well, banks have a lot of laws and regulations that require them to keep a certain amount of capital in reserve at any particular time, literally for any day. So banks are out there every day lending money, paying out deposits, bringing in deposits. And in order to do all that, there's a regulation that says banks have to keep a certain amount of cash on hand. It's literally called a reserve requirement. So as you can imagine, some days a whole bunch of people will take out money, or the bank will do something and they'll go below that threshold for a particular day. So at the end of the day, before the next day starts, they need money literally overnight in order to meet their reserve requirement. So this is where the Fed comes in. So what exactly is the Fed funds rate? Well, if a bank needs to borrow money from the Fed, literally for like a day, the Fed is going to charge that bank interest. And that interest rate is what's called the Fed funds rate. Now remember, banks don't have to borrow money from the Fed. They can borrow money from other banks. But when the Fed is lending money out at this interest rate called the Fed funds rate, that basically sets the standard for what other banks could charge, because everybody has to essentially compete with the Fed's overnight rate. Okay, so if that's the Fed funds rate and we as consumers don't have access to it, how does that impact mortgage rates? So when a bank lends money, all of those interest rates for all the different types of products are anchored to what's called a bank's prime rate. Okay, so we have the Fed funds rate, and now we have the prime rate that we're talking about. So the prime rate is what banks charge their best, most highly qualified, best credit-worthy customers. Those customers are considered very low risk for the bank to lend money to. So the prime rate is basically what all loans interest rates are kind of anchored to, whether it's credit cards, auto loans, CDs, whatever. And the prime rate is typically 3 percentage points above the Fed funds rate. So that's how the Fed funds rate and the prime rate move together. But here's the thing, prime rates and mortgage rates aren't tied together. A prime rate influences all of the shorter duration loans that banks make. Mortgages are 15 or 30-year durations, a much longer duration. So when the Fed changes the Fed funds rate, that influences the prime rate, which influences short-term rates for the loans that banks offer, but it's not directly tied to mortgage rates at all. So when the Fed says that they're lowering the Fed funds rate, that will lower the prime rate, which will lower all other interest rates, which will influence what mortgage rates do over time. So when people get all excited that the Fed lowered the Fed funds rate or the Fed lowered rates and here come a mortgage rate drop, it's not directly tied to mortgage rates. So it's great for the long-term aspects of housing, but there's not going to be an immediate impact. Okay, so what does change mortgage rates then, if it's not Fed funds rate or prime rate that it's tied directly to? So mortgage rates are tied to essentially the long-term sentiment of the US economy. And I know that sounds fluffy because it is. And there aren't very many metrics that measure the long-term sentiment of the overall US economy, except one. It's called the US Treasury's 10-year bond. So if an investor wants to park their money in a very safe, long duration type of investment, there aren't very many options other than the US 10-year Treasury bond and mortgage-backed securities. Okay, so how do 10-year Treasury bonds impact mortgage rates? Well, most mortgages only last 8 to 10 years, even though they have a duration of 15 to 30 years, because people on average buy or sell their home every 8 to 10 years. So while they're not tied directly together, they move in the same direction because they're essentially competitors for investors who are looking for long duration, safe investments. So to bring it all together, the Fed said they'll be lowering interest rates to a target of 50 basis points or 0.5%, which is essentially a signal of two things. First off, the Fed is doing this because they see weakness in the US economy, which is a strong likelihood that we're heading into a recession. Second, when the Fed starts lowering rates, they usually don't stop for several months or even a couple of years. So overall, mortgage companies And investors that set mortgage rates are seeing all the signs that mortgage rates should drop slowly over the foreseeable future. But don't expect rates to suddenly plummet just because the Fed announced what they're going to be doing. What we've seen since the Fed announcement and what we'll continue to see in the short term are mortgage rates being pretty volatile, bouncing up and down. But overall, through the long term, we'll continue to see mortgage rates decline. Because the Fed has signaled, US economy is heading in that direction. Okay, so now hopefully you have a better idea of what is the Fed, what's the Fed funds rate, and how it impacts mortgage rates. If you have any other questions, feel free to drop a comment below or reach out to me or any of my teammates at Novum by visiting our website, novumhomeloans.com. Thanks for watching.